everybody, and welcome back to my YouTube channel. If you are new here, then welcome. My name is Rachel and I am a disruptor in the accounting industry, and I'm disrupting what it means to be an accountant, what it feels like to have an accountant, and showing you the behind the scenes of what running an accountancy practice in your 20s really looks like. I create long and short form content across YouTube, TikTok and Instagram, and so I would absolutely love to see you guys there, where I share daily behind the scenes content of what it's like to scale a business in your 20s. You can use the links in the description of this video to find me everywhere you consume content. And this content is literally the content that I desperately needed at different points in my journey so far. And so this is by me and for you. So again, if you've got any questions or content requests, you can pop them in the comment section, and that drives the content that I bring to you guys next. In today's video, I am talking and unpacking everything that you need to know about SEIS and EIS investment schemes in the UK. As a rapidly scaling accountancy practice, we do some incredible and amazing, exciting work with companies who are trying to get angel investment, angel investors, and the entire due diligence process. And so today we're going to go through what both EIS and SEIS schemes are, the benefits of both, and the rules and requirements to be aware of if you are an entrepreneur or an investor looking at these schemes. There are a fair few rules and regulations to wrap your head around, and so with this video, grab a cuppa, get cozy, and let's get into it. So let's kick off with EIS. So EIS is short for the Enterprise Investment Scheme. And EIS is one of the government initiatives which was introduced to encourage private angel investors to invest in upcoming and exciting UK businesses like yours, which might actually normally be higher risk than investing in other businesses. And when I say high risk, this is literally just because you guys are a young business or a new business and therefore might not be guaranteed to succeed, but they have high growth potential that literally would benefit the UK economy. And so companies qualifying for the EIS are small and usually privately owned. They'll typically be established in the UK and have gross assets of less than £15 million at the time of investment. The additional criteria is that the company must have fewer than 250 employees, must not be trading on the public stock exchange, and has to have been trading for less than 7 years. Finally, to qualify for EIS, the company should not control another company other than qualifying subsidiaries. Nor should it be under the control of another company or 50% or more of the shares owned by another company. To qualify for EIS, a company also needs to be carrying out a trade with a view to making a profit. And this trade needs to be what HMRC calls a qualifying trade. You will be good to go as long as the following trades account for less than 20% of your business. So things like leasing activities, legal or financial services, property development, banking services, running a new hotel, just to name a few. And there is a full list available on HMRC's website. And so if a business qualifies, it is actually eligible for a £12 million investment through the EIS scheme. With the EIS scheme comes the opportunity to back what are known as knowledge intensive companies, or KICs. And these are businesses whose activities are primarily centred on research and development. There are even more specific criteria which a business needs to meet in order to be considered for a KIC or EIS purposes. If a business does qualify as a KIC, it's then eligible for £20 million worth of investment through the EIS scheme. So that's EIS, but what's SEIS? And so SEIS, on the other hand, stands for the Seed Enterprise Investment Scheme. And the SEIS scheme was introduced by the government following how successful the EIS scheme was. And so with SEIS, the idea is to help even smaller and probably even younger businesses to raise funds and grow. So in summary, SEIS is designed for startups in their early years, whilst EIS is for slightly more established companies. SEIS qualifying companies must be less than 3 years old, have fewer than 25 employees, gross assets of less than £350,000, and cannot have taken any EIS investments or investment from a venture capital trust in the past. Again, the qualifying trade rules that we have already considered apply here, both for SEIS and EIS. And some companies and sectors are excluded, including those dealing in land, commodities, or shares. And so if your company fits the criteria, you can receive a maximum of £250,000 in funding through SEIS. And if a business wants to raise more than the SEIS limit, of £250,000, then it can always start taking on EIS investment once the SEIS funding limit has been hit. Okay, so that is what EIS and SEIS are, but why would you look to invest through SEIS and EIS? So if giving small businesses the chance to expand and rapidly scale isn't enough to interest you, then perhaps the tax breaks will. Yep, you heard me right. So if you invest through the SEIS or EIS schemes, then there are a number of upfront and ongoing tax reliefs that you'll be eligible for. So as of April 2023, investors can invest up to £200,000 per tax year in SEIS eligible businesses and then claim 50% of that back through income tax relief, which literally means that they could reduce their tax bill by £50,000 each year through SEIS investments. Investors can invest up to £1 million in EIS eligible companies and claim 30% of that back through income tax relief. This rises to £2 million if at least £1 million is invested in knowledge-intensive companies. That's not all though. So 50% of capital gains are exempt from capital gains tax if they are reinvested into SEIS and EIS eligible businesses. For example, if an investor sells a property and makes a £200,000 gain on the property, they would usually have to pay capital gains tax at a rate of 28% on that profit. But if they invest that £200,000 straight into an SEIS or EIS qualifying shares, then the capital gains tax that they have to pay on that profit will literally be halved. Any profits that come from the sale of SEIS and EIS shares after 3 years are completely exempt from capital gains tax. Inheritance tax doesn't apply to SEIS and EIS shares held for at least 2 years either. And finally, if that's not enough, if SEIS and EIS shares are sold at a loss, investors can offset the loss against their capital gains tax liability or income tax liability as is their preference. So with all of those benefits, there must be some catches to the scheme, so I'm just going to run you through the rules and requirements. So aside from all of the eligibility criteria that businesses need to meet in order to be eligible for investment through EIS or SEIS, the money that you raise through SEIS and EIS also does come with a few conditions. So firstly, as the business owner, as the entrepreneur, you can only spend the funds you raise through these schemes on either expenses that are going to help grow your company, like hiring new employees or marketing your business, research and development that's going to help you grow your company down the line. And so this could include spending on new development of product or researching ways to improve an existing one. You also would need to spend the money you raise through SEIS within 3 years and the money you raise through EIS within 2. So those are the schemes. That's why entrepreneurs love them. That's why angel investors love them. But let's just run through what you have to do in order to officially make shares in your company approved for SEIS or EIS. So in order to be able to raise funds through either scheme, your business needs to get approval from the government. So whilst you might think that it would be quite simple to determine whether your company ticks all of those boxes, running through each of the criteria, investors would want to be absolutely certain that any money they invest in your company will qualify for tax relief before they give up their cash. And that's where the SEIS and EIS Advanced Assurance comes in. So Advanced Assurance allows you to check with HMRC to make sure that your startup or your business qualifies for SEIS or EIS before you apply. This ultimately gives the person or organisation lending you the money peace of mind, and most SEIS and EIS investors will not invest without it. So when you're applying for Advanced Assurance, you'll be asked a number of questions about your company, your business plan, how you're planning on using the money when looking to raise, and HMRC will then take all of this information and decide whether your company qualifies for the scheme that you're applying for. So whilst you don't require Advanced Assurance to qualify for SEIS or EIS, you are definitely going to want to apply for it, and you can apply for Advanced Assurance on the government website, or you can ask an accountant like me to help you build that. And so that is a wrap. Today we have covered everything on what is EIS, what is SEIS, benefits, the rules, the requirements, the SEIS and EIS approval, which will have answered all of your questions about the EIS and SEIS scheme. So please do let me know in the comments section what you found the most helpful on this video. Thank you so much for spending some time with me today, and I hope to see you again very soon.